Hello, everybody. A little housekeeping. I will tell you, I'll stop at occasion so you guys can laugh at my jokes. And basically, if you got the feel from Christina that they're slightly against this law, that'll be more than echoed on my part. I'm going to focus on how it really affects us as businesses. In some ways, at the end, I'm going to get into how we can mitigate some of those effects. But at the end of the day, there's really, from our perspective and from the effect it has on you as employers, it's not a good thing. And that's not a political issue. It's just, it does create an unwieldy burden on you as employers. We're going to do a lot of things to step up and help you in that, which I'll get to at the end. But just to full disclosure. So how does Obamacare affect my business? And you've heard of different names, PPACA, Affordable Health Care Act, Healthcare Reform, Obamacare, it's all the same thing. Okay, so what we're going to cover, we're going to talk about the mandates, go in a little bit more detail, both the individual and the employer mandate. We're going to talk about some requirements as far as compliance and reporting. We're going to talk about how the marketplace is going to change in 2014, and then finally we're going to end on what you guys can do to prepare in 2014 and what we're going to do to help you get through that. So, time's still a-changing. There's a lot of regulations not yet released. Christina mentioned that the law itself is well over 2,000 pages. The regulations that both HHS and the IRS have put out so far are an extra 2,000 or 3,000 pages, and they expect to have yet another 2,000 or 3,000 pages on top of that. So things are still changing, and everything that I'm telling you now is subject to, in a week from now, they'll issue new regs right up to the end. Now, the good part of that is because the government hasn't even been able to do their part in just creating rules and regulations, which you think they're pretty good at. They haven't even met all those deadlines yet. There's a high likelihood that there'll be delays, and a lot of the deadlines could very well be pushed. So what looks like it's going to happen January 2014 very well may not happen and may be pushed down the road. Christina also mentioned the Oklahoma case. That's going to have obviously a huge impact. And then separate from that, the feds, they have to do the rules and regulations, which is one thing, but they also have to do real work. They have to create exchanges for these 26 or 32 states that the states have opted out. They have to create websites. They have to create a whole personnel structure. It's a lot of work for a competent business to do, let alone the federal government. So a lot of those things will naturally, I can't promise it'll delay things, but I would say more likely than not cause delays in deadlines and cause a lot of these things to be kicked down the road a little bit. Obviously, I'm going to put the standard disclaimer. Everything I'm telling you, check with your attorney. I'm not giving you legal advice, but here you go. It's a nickel's worth of free advice. And don't mind that man behind the curtain. All right, so as Christina mentioned, most states are opting out, whether you go with 26 states or actually 32 based on the legal definition. There's more states out of this thing than in it at this point, and if the Oklahoma case goes our way, that'll be a very significant issue. All right, so let's talk about the mandates. So there's a lot that has to do with Obamacare. Basically, what I'm going to talk about is a little bit the individual mandate, and then I'm going to get more in detail the employer mandate. But the individual mandate has some effect on the calculations for the employer mandate as well. All right, so y'all got my little suppository joke. All right, individual mandate. So first thing, the individual mandate, the mandate that individuals have to have health insurance, applies to all individuals, and your responsibility is not only you, but all the dependents on your tax return. So your responsibility as an individual is for you, your spouse, your children, and anybody else that may be on your tax return. The general mandate is that you have to have minimum coverage. That's defined as, some people call it the bronze plan or the copper plan. They come up with a plan which is 100% of actuarial value, and then they say you have to have something that's at least 60% of the benefit of that. And each state's going to be a little different, but basically there's going to be minimum allowable coverage. And you either have to have that coverage, or you have to have a qualified exemption, or you pay the penalty. Penalty in 2014 is $95, or 1% of your household income, which is your adjusted gross income on your tax return. It goes up to $325 a person, and then $685 a person. Now that's a person, so if you're a family of 5, you multiply that number by 5. And if you happen to be making a whole bunch, don't even worry about that number. It's 2.5% of your adjusted gross income. Some of the exemptions that they allow are financial hardship, which you would apply through the exchange for qualified financial hardship. Conscientious religious objection, that you belong to an actual religious sect that doesn't believe in health insurance, or you're earning below a level that would require you to file a tax return, which basically is $12,000 in 2012. It'll be a little higher than that, and if you're a family, it's $19,000, so it'll be about $20,000. In addition to the individual mandate, individuals making over $200,000, you're going to see an extra 0.9% withholding for Medicare. So you're not going to, so anybody getting a paycheck where it bumps over $200,000, you're going to see it cap off, and then it's going to, and then you're going to see at $200,000, you're going to see an additional 0.9% come out of the employee's paycheck. It doesn't come out of there's no employer matching on that. In addition, for those of you with any investments, anybody earning over $200,000 generally, there's going to be 3.8% surcharge on your investment income, like your capital gains and dividends and so forth, on that portion of your income. Okay, so tax credits. There's a small business tax credit, which only applies if you have less than 25 employees. Owners aren't considered to be employees, and family of owners aren't considered to be employees. If you have less than 25 employees that are earning less than $50,000 average salary, then up to 35% of what you're paying towards health insurance, you could get a credit. Now that's a declining number, so if you are at 0 average salary, you get the full amount. If you're at $50,000, you get nothing. So as you get closer to 25 employees, as you get closer to $50,000 average salary, that subsidy goes away. And we've been doing the calculations for most of you just to see if anybody qualifies. And there's a few dollars here, a few dollars there, but it's not any real money. The individual credit. This is real important for something we're going to talk about later with the penalty. So the individual credit, separate from the employer responsibility, an individual is eligible for a credit if they earn between 133%, and in some cases it's 100%, but we'll say 133% to 400% of the federal poverty level, which comes out to about $44,000 for an individual, $88,000 for a family this year, and it's an increasing number over time. And their minimum coverage that they'd have to get, so if they just bought an individual policy or were offered insurance through you guys and their employee deduction amount, if the amount that they're going to have to pay out of pocket is more than 9.5% of their household income, then they're potentially eligible for this credit. Not very relevant for purposes of the employer responsibility, but it will be when I get into the penalty calculation in a second. Okay, and then the credit, whether it's the business credit or the individual, either people can take it at the end of the year with their tax return, or they can get it subsidized and actually reduce their premium. There you go. Okay, so employer mandates. Let's start with all the fun things that are going to impose on us. Number one, no more management carve-outs. You offer insurance to one person, you got to offer it to everybody. Everybody that's full-time. And they define full-time as 30 hours a week. No separate waiting periods. Your management people and your field people have to have the exact same waiting period, and that waiting period can't be more than 90 days. And no difference in contributions. The owners, the managers, the field people all have to get the same contribution. You can't have a contribution that favors the highly compensated people. There's a penalty if you violate any of that, $100 per day, per incident, up to $500,000 a year. We're going to make sure that we look at the numbers all the time and make sure that everybody's in full compliance with that. Maximum 90-day waiting period. You can also offer first of the month after 60 days as an option. There's significant reporting requirements, which we're going to get into in a minute. Again, TAG takes care of a lot of that for you guys, but we want you to know what it is. If you have over 200 employees or full-time employees, right now this regulation's on hold, pending final guidance, but you'd have to auto-enroll your people on the insurance. There's no sign-up provision for them. They just go on the insurance unless they opt out. And then, most importantly, employees that have more than 50 full-time employees or full-time equivalent employees, so 2 part-times or 2 15-hour people effectively add up to 1 full-time person. You have to offer coverage for your people. All right, so congratulations, most of you just become large employers in the eyes of the federal government. You now have to provide affordable insurance and pay, or if you don't, you have to pay 1 of 2 fines. And Christina talked about it a little bit. I'm going to get into that in a little bit more detail. The fines aren't as grim as some of you have heard, and there's ways to definitely minimize the amount of that. This applies to employers with over 50 employees, and it takes effect January 1st, unless you have a plan year or a fiscal year plan, and at least a third of your people are offered insurance. Then it takes place on your renewal. Okay, so are you a large employer? Number 1, do you have more than 50 full-time employees or full-time equivalents? Number 2, you are able to exclude seasonal employees as long as they don't work more than 4 months of the year. The question about who is an employee is still a little bit up for grabs. Most of the laws using what is called common law, so whether you were using us or you were coming from, a lot of you came from an employee leasing arrangement, or if you're actually using a staffing company and had a lot of your employees from the staffing company and had them for an extended period of time, those would generally all be considered employees, although some of those rules are subject to a little bit of fine-tuning. Also, 1099s, whether someone's a W-2 or 1099, they could still be considered an employee for this purposes to get you over that 50 mark. Now, if you come up with the idea of, all right, well, I have 100 employees, so guess what? Now I have 3 companies, each one with 33 employees. I tried that one myself. They caught me. There's common ownership. They do a test to see if these entities are related by common ownership. They use what's called Section 414, which governs a lot of other rules like benefits and 401k rules. And generally, if these companies have more than 50 to 80% common ownership, and there's some other tests involved as well, it's considered one big entity for purposes of doing the count. And if you say, well, okay, then I'll have this company owned by me, this other company owned by my wife, and this other company owned by my kid, well, they also figured a way around that. This rule applies to anything where there's any mothers, fathers, children, sisters, brothers, or spouses involved. That's all considered one. Now, having said that, there's still ways to be in compliance, and after the Q&A and when we have the happy hour, we'll talk in more detail if you guys have some personal situations that you want to walk through. There's definitely some situations with trusts and things like that there are ways to have maximum compliance and still, follow, not break the bank.